All right, I have with me today Todd Horwitz. He's been on the show many times, and I appreciate his expertise. Over 40 years of real world trading experience. Todd, thank you so much for being on today's show.
Stephen, it's always great to be with you. It's always great to talk to real people about real stuff.
Yeah, well, it's getting real right now. I want to jump right into this banking crisis. I want to get from your perspective what's going on, because the media is projecting one thing, the U.S. Treasury is projecting another, and then YouTubers like crazy are just milking this for clicks and leads. What's really going on with the banking crisis?
The banks are in trouble. You and I have talked in the past about that they're over leveraged, and that the fractional banking system of allowing a bank to lend 10-1 to assets they're holding was a little flawed to begin with. But then when most banks don't have enough assets to lend the 10-1, it becomes really tricky. And really, when you look at their accounting practices, the Fed's funding rate, which is the rate we had on Wednesday, the FOMC decision, that's from bank to bank. And they can actually borrow $1 million, take that $1 million as a liability, turn it into an asset, and then lend out 10 million against a $1 million liability that they have. And of course, during COVID, they allowed the banks to go higher than 10-1. And I would venture to say that if they took a real stress test, with actual forensic accountants, not many of the banks could pass the real stress test. And that's where we have the problem. If you think that only 3 banks are in trouble, which is right now Signature and SVB and Republic, you're wrong. I mean, this is just a symptom. We heard Janet Yellen come out and say, "Hey, everything's okay." Well, it's like when a coach in sports comes out and says, "Hey, you're doing a great job," and they fires the coach the next day. This does not look good.
Yeah. Okay. So just so that my viewers understand, with the fractional reserve lending, they can take a loan from Jerome Powell for $1 million, and then they can turn around and basically invent $10 million in order to lend debt.
That's correct. They can take a liability, turn it into an asset, okay, and never have to be responsible for any of the 1 million that they owe the Fed, because of course they're collecting from everybody else, which automatically pays off that debt on the interest. So it's very tricky, but it's how we get into trouble. It's how we live in a supply side economy versus a demand side. And when you live in a supply side, you don't let businesses go broke. You don't let bad practices stop. So why, if you're a bank, why would you stop?
Yeah. Elon Musk from Twitter and Tesla, he threw out an idea of saying no more bank bailouts, but it's time for the federal government or the FDIC to guarantee depositors that their money is safe. Do you think there's any wisdom in separating that, or is that just another balloon that's being pumped up that will pop eventually?
He stole that idea from me 15 years ago. I actually said that after the 2008 crisis. I said the bank should not be bailed out. Bail out the depositors, but a bad business is a bad business. Let them go broke. There'll be new banks to take their place. You have to remember that the FDIC has insurance, which is fine, but like SVB, the Silicon Valley Bank, everybody knows the law or the rules, which is $250,000 per account. So why would people have more in their account than that? And why would the FDIC bail them out when they're giving them more money? That makes no sense. It's against the rules. And of course, they're only helping the very wealthy. And of course, the Democratic Party in this case, because SVB is a very heavy donator to the Democratic Party.
Really? Okay, that's interesting. So I was thinking, I know you've heard this, but basically it's like capitalism for the working class and socialism for the elites and the wealthy, where you and I aren't getting bailouts. You and I are expected to be good fiduciary, responsible stewards of our paycheck, pay our bills on time. If we run into problems, we end up at title loan companies, borrowing from family or friends, or we've got to cut back on Netflix, maybe don't get the newest iPhone. But the wealthy, they continue to get bailed out. What are your thoughts on that?
Well, I think it's a tragedy. But again, and you know who's doing the bailing out, right? You and me, the taxpayer. Because government and the Federal Reserve don't create anything but debt. So we have a government that overspends, and that's not just this administration. This is all government. They've overspent forever. And of course, at some point, when are they going to have to look in the mirror and say, "Hey, we can't spend so much"? And of course, if we did it, you did it, we'd be in jail or in bankruptcy court.
Yeah, but they are given the, what do they call that? The golden handcuffs.
The golden parachute, the golden handcuffs.
The golden parachute. That's it. Velvet handcuffs and golden parachutes. So, okay, excuse me. So one thing that I'm concerned about is during the Great Recession, which hurt so many Americans, the housing market, the lending market, real estate, businesses, Janet Yellen was the head of the Federal Reserve under all of this. And now they've just brought her back in to be the other side of the coin, which is the Treasury Secretary. Is this coming down to who's in leadership positions, or has it come down to the policies and Wall Street just having the cojones to know that they're going to always get bailed out?
I think it's a little bit of both. Again, I think we need to rewrite a lot of what we do. And unfortunately, it's not going to happen at this point. And of course, they're trying to take away more of our freedom. They're trying to take away more of our money because, again, the good old taxpayer is there to bail out everybody. And, Janet Yellen has no clue. I mean, again, it's amazing how smart people can be from a book standpoint, but when they go into an office, either like the Federal Reserve or the Treasury, and they go, "Oh, well, I don't have to be that anymore because now I have an unlimited power of the pen," or now it's the button. I can create digital stuff, right? I don't even have to put it in a pen. I don't have to print any more money. I can just do it digitally. It's a very sad state of affairs of what we have going on here. And it continues to go. It's the same as the debt ceiling, Stephen. We every couple of years we have to go through this debt ceiling debate. I'll go back to why are they not limited to a regular budget like everybody else? Why did Congress take 2 raises since COVID, one during COVID and one after? It makes no sense that the average American is struggling. The average American's in a recession. They can't afford their bills, and yet Congress keeps taking raises and they can't stay under a budget.
Help me. You're good with the math here. AOC, Representative AOC of New York, said that it's impossible for her with no children and I believe a fiance to live on $185,000 a year. And yet, what would you guess is the average income of the people who voted her into office?
50,000, 60,000. It's New York, so maybe 70,000. It ain't much. Listen. I think the average income now is about 50,000. Okay, in the United States. I mean, and there's a lot of diversity between that, right? There's a lot of big earners that bring up those lower earners, and they've destroyed the job market at the same time. We get these job reports that come out and it says, "Well, we're great. Jobs are great." Really? Everybody's working part-time jobs. They're working 2 and 3 part-time jobs. And think about this for a minute, Stephen. You take away a full-time job that has benefits, and you put somebody to a part-time job that has no benefits. So if a guy was making $50,000 on his job, plus his benefits is about a $70,000 a year job, you put him in $50,000 minus his benefits, he's in a $30,000 a year job. What kind of equity is that? 180. She can't live on 185,000. She should, she's a bartender. Let her go back to tending bar. That's where she belongs.
Yeah, it just like maybe I'm missing something. It's just going right over my hair. But
she drives a nice new Tesla too.
But has no money to help her grandma in Puerto Rico. Okay, so that's a side story. Okay, so the Federal Reserve has announced that they're going to raise interest rates 25 basis points. Obviously, the stock market reacted negatively to that. I was a little bit surprised because they knew that was coming, yet they still had the reaction. Do you think that there was a part of them that thought they're going to pause rates with the SVB crisis in the news, or what do you think caused that drop?
Well, you remember the markets rallied all the way into the Federal Reserve announcement. There's an old story in Wall Street: buy the rumor, sell the news. Okay, so they were buying into this before it happened, and then the news came out. Well, it was as expected, and I think had they raised 50, okay, or done nothing, you would have seen a collapse. We had a big sell-off, but the market's already recovered all their sell-off. So I think that a no increase would have indicated that they might think there's more trouble ahead versus raising what everybody expected. And I think the Fed is dead set on getting the 10-year notes up to 6%, which would put mortgages at about 10%.
Wow. And so tell me if I'm wrong, but isn't the automotive and lending and the housing market like a major portion of the US GDP?
Yeah, it is. And of course, it's the housing market is collapsing. This is what makes no sense. Now, again, I'm all for higher rates in general. Higher rates are very important to the elderly. They're important to depositors. These 0% interest was no good for anybody. Okay, except for the very wealthy who can borrow all they want. But we need higher rates, but they have to let the free markets decide what rate should be. So I'm happy that they're raising rates, but I think they chose the worst possible time, which you and I have talked about before. No Federal Reserve in history has ever raised rates into a recession. And that's what they're doing. And they're not done yet. I know that part of the speech from Jerome Powell was when we may be reaching the end. Inflation is nowhere near done yet. We're fortunate, or not fortunate because the economy is in bad shape, that oil has fallen so hard. But think about this. We're going to be coming into driving season in about 6 weeks, 7 weeks. And I'll bet you that Saudi Arabia will cut production and those prices are going back up and zooming back up at the pump, come back when we really need the oil.
Yeah. So speaking of that, China has been working very hard to broker peace between Vladimir Putin and Ukraine. At the same time, they've been working overtime to make Iran and Saudi Arabia make up and not be enemies. And what they're finding is, wait a minute, maybe it's the United States that is the enemy. Is that going to be a part of OPEC's decision with oil pricing and the amount of production that they're willing to do and how much they're willing to sell to us?
No, I think that OPEC is almost like a criminal organization, like a gang, the gangsters. And I think that they know that our economy is bad. They know that the cost of production out of Saudi Arabia is virtually nothing. Okay, they don't pay their help any. They have slave labor there working. If they tell you it's $50 a barrel to produce, they're full of, you're full of what. So I think that China is brokering everything because China is trying to take over the world, right? We know that China has the 100-year plan. Okay, we know that China is getting more into bed with Russia, which is not a good thing for the United States. And because the United States is exercising so much weakness as a country, and because we're giving away everything, give it away. It's okay. Give it to them. Keep giving Ukraine billions and billions and billions of dollars. It doesn't matter. Okay, because we got taxpayers that are going to pay the bill. And we want that great reset anyways. I think that Saudi Arabia, as they did in the 70s, when we were buying oil, when oil was $10 a barrel, and suddenly I actually was pumping gas back then. It was 48 cents a gallon. It went to $1. We're going back much higher. I think that crude oil is going to all-time highs before this is all said and done. And I think it will be strictly correlated with what Saudi Arabia wants to do. Aramco, which is the corporation of Saudi Arabia, their oil, it has the largest profit gain in history and the biggest company in the world. Okay, what does that tell you with these low oil prices?
Yeah, well, it tells me, number one, they're going to want to continue to make all of that money. Whether they want to make it in U.S. petrodollars is anybody's guess at this point, right? We know that ever since the fall of Afghanistan, they have been flirting heavily with allowing other currencies to be a part of the petrodollar or the basket of currencies that they are willing to accept money from. So by aligning China and Russia and China and Saudi Arabia, does this in fact position China, maybe not to take over the world in our lifetime or eclipse the petrodollar, but are they making smart moves as a country that is going to put the United States in a one-down position?
Well, they're making a mistake. They're hurting the United States, but they're hurting themselves at the same time. China is not where you necessarily want to be. You can say whatever you want about China, but they don't have a very good reputation, and they certainly don't have a good reputation for keeping deals that they've made. Example, Hong Kong. right? That was supposed to be left a free country, and it was not. The minute the deal, 5 minutes after the deal expired, they were in there with the soldiers. Okay, look, China it may do a great job at manufacturing. It may have slave labor, but we know that their human rights are the worst in the world, and that we should not let them gain as much power as they're gaining. And that to me is even a bigger problem when we start to look at it.
Yeah. Okay. A lot of people are, I hate to say this, but I guess they're starting to get accustomed to these higher prices because what do you do? There's only so many coupons that you can clip or things that you can say, okay, we're going to put off this purchase or whatever. And yet at the same time, the U.S. economy is moving along. Where do you see inflation going? Is it going to be sticky for another 12 months? Are they going to eventually get it to come back down? Where do you see the future of inflation?
Well, the only way it's going to come down is if we get into stagflation, which would be the worst of any. If anybody remembers this, the late 70s with Jimmy Carter. I think that we're going much higher. I think that inflation, first of all, the number that they report, which is 6.2, I think was the last report, is garbage anyways. I went to the grocery store, and when I go to Vegas myself, I have to do my own shopping. Item over item, exact same list was 40% higher last time I went. Okay. Nothing's coming down. You have to remember, we're being fortunate right now because they've held down commodity prices for whatever reason. And I've got a theory about that, but that might be for another show. Okay. But commodity prices are being held down. If they should be much higher with the input cost. Farmers have a lot of expense. And not only do they have the input costs using a lot of oil products and hydrous ammonia and all those other things, but money. They borrow a fortune and they pay more per loan than any normal person because their capital is considered risk capital. So it's a much bigger problem. And I could see once it gets going, if we don't go into stagflation, we may go into hyperinflation.
Okay. Boy, we definitely don't want that. Okay. So you brought up commodities. I had another person there in the Las Vegas area by the name of Gregory Manarino. I don't know if you're familiar with him or not, but he talked about how he sees the stock market coming down further, and then there being almost like an avalanche of money shifted over into commodities. Do you have that same perspective, or what are your thoughts as far as commodities?
I think commodities are in for what they call it a big market. And I think Goldman Sachs is on board with that now as well. I've been talking about it for about the last year that I don't know, it hasn't come yet, but I feel that that's where we're going. I think the equity market is going down 50 to 70% from, a year ago, wherever we are now in total. Before it's all done, we'll be cut in half. That's my opinion. That's where I stand. I haven't changed my views there. I'm still investing, but again, one thing has nothing to do with the other. My opinion is that we're going to see a major collapse here, and we're only on the verge, right? We've only seen 3 banks admit to having trouble. Wait till there's 50 banks and 80 banks. We're already getting letters from our banks telling us how good a shape we're in. So I think that that's going to be the impetus once again to push it down. It'll be from the banking industry. People can't afford rent, mortgage, food. It's going to cause problems, and I think that we end up seeing that this money that will flow from the equity market into commodities, because that is the second great alternative market, especially the grain markets, which is a big place where money goes. And of course, that directly affects you and me, the consumer, when we go to the store to eat.
Yeah. Okay. So let's just do a hypothetical, because I'm trying to help people protect their money and grow their money, right? But let's say that money moves over. You've already mentioned grains. What are some other, for lack of a better word, safer commodities, but also potential return commodities that people could just begin to research?
Well, I think that, listen, I look at cotton, for example. Okay, cotton is down at lows that we haven't seen for a couple of years. It's 50% down from its highs. You have to be careful in the commodity market because it can get kind of whippy, and you know how human nature is. If it goes against you a little bit, you get too nervous, right? But you can use and get involved in things like the grain markets. You can get involved in the cotton and things like that. Potentially coffee, at some date. But again, remember, these are very volatile products that can cause you a lot of heartburn. I think right now, what I would be doing is looking for some small investments in those that would looking for some larger returns, but also, with CD levels at some of the brokerage houses, like for example, Edward Jones, my son's an advisor for Edward Jones, but there I've got a lot of money in at 4.75% on 3-month CDs. Okay. So they're telling you that rates are going higher. And I think you put yourself in a position of safety and looking for places to spot purchase, maybe some grains, maybe a stock. Listen, the stocks will get, if we do what I think we're going to do, some will hit there much earlier and get their lows long before the markets make their low. And I go back to Amazon in 2008. Amazon got down to $30 in 2008. That was the low. By March of 2009, when the market bottomed, Amazon was already 70. So wow, I think if you look for value plays, you look for an Apple to get trashed, some of the banks to get trashed. Things that are companies that you believe are going to be in business the next 20 years. That's what you want to buy. Okay, where you understand that they can go lower, but if you're buying at value on something that's going to be strong, it does have a value of 8.5% year over year in history. But again, I do like the commodity markets, and certainly the best and most liquid are the grain markets. Okay. That is where the most liquidity lies. I think you look at oil, and with the micro contracts and futures now, okay, micros are very inexpensive to play, and they have there's risk, but the risk is 1/10 the size of a normal commodity, the normal contract.
Yeah. Okay. And would you say if somebody is looking into like natural gas or oil, should they be looking for growth opportunity, or should they be looking for the dividend return, or a blend of both?
Natural gas is a very tough product to trade. Okay. Let me just give a quick education here. Commodities trade in a cycle. Okay. They have different month expirations. They work on different schedules, but like natural gas is a monthly expiration every month. But if you go out farther, what they call the curve, and if I look at October natural gas right now, it's $4. Okay, versus April, which is $2.20. So they're already accounting for when demand season is back. And plus the fact that the tick sizes and the movement, I don't think a lot of average people could handle the movement in a natural gas, because it can move thousands a day for you or against you. And what human nature is like. And again, if you don't understand, it's called contango, which is the price that gets higher as you go into the future, or backwardation, the price gets lower as you go into the future. I think that the average investor, because you don't understand that, and that is why many of those ETFs that are supposed to mimic commodities don't work, because they don't understand the backwardation and contango formulas that go into them. And that's what you have to understand. That's a very tricky market, and I would advise anybody who doesn't understand it to stay away from products like that.
Okay. Yeah. We don't want to be leading people into risk just because somebody with, 44 years of trading experience, has that feel for what's going to happen. As far as, you mentioned CDs, bank products, let's talk about treasury bills and notes, and then we'll wrap this up. As long as people are under that 250,000, do you feel like people should be taking advantage of those safer, shorter time frame opportunities until the markets find their new bottom and move forward again?
I think they should have a blend, Stephen. I think that you put some into CDs. You might dabble some in the markets, but have some fresh powder, as they say, to buy more if it goes against you. But in the meantime, instead of leaving your checking account getting 1%, you might as well go to like an Edward Jones or somebody like that and get 4.5 or 4.75%. And you want to keep the duration period short as you can, because even though it's a full year will pay more, it's better to keep rolling it over. So when the opportunity does present itself in the market, you have fresh capital and don't have to wait for the CD to mature.
Okay. Last question. People in the community that have less than $10,000, what is your opinion on the I bond, the inflation bond? I think it's paying around 6% or something. You can't put a lot of money into it, but again, for those that have maybe less money, what are your thoughts on those? And then we'll wrap it up.
Well, if I'm going to get 6% on an I bond, I can get 5% or so in a CD. I'd rather take the CD. I think to me that's a better play.
Just because the time frame is shorter?
The time frame is shorter, and plus the fact that again, bonds are tricky. The value of the bond changes, as does the yield, as it goes up and down. One of the big problems with SVB Bank was they had bought bonds that they were going to carry to maturity, which was fine, except that they didn't have enough assets underneath to cover up their leverage. So, that's the issue. When you get into some of these other products, if you're going to be watching them or looking as like a trade or a quicker move, you don't want to go into things that can go against you. We know that if it goes to maturity, it's worth X. But again, in between now and X can be a lot of heartburn for many. And I think it makes it much easier and much more peace of mind that people can sleep at night knowing that they're getting 5% here, and that's it. Goodbye, good night, and good luck.
Okay, great. Thank you so much for coming on today. If people want to learn about your Monday night phone calls or get more information, where can they turn to?
They can go to the website, which is bubbatrading.com. And if you have any questions about what we talked about or anything else in general about markets, anybody can email me directly, bubba@bubbatrading.com. I'll answer you. I will give you a detailed answer of what I think and why I think it. And I just listen. At my age, I've been very fortunate. I just hope to help others.
Great. Thank you. I know you have. You've been generous with your time. I very much appreciate it. If you want to learn more, check out Todd Bubba Horwitz at bubbatrading.com. Thank you so much for being on today's show.
Stephen, thanks, brother. I appreciate it, man.